So who am I? I started out, I went to the University of Waterloo, went for computer science there. At the time, I was living with my roommates. It was one of these student rental homes, got like 10 of us, I think, all jammed into a house, all illegally subdivided. And my roommates were watching Oprah. My roommates were watching Oprah. It was not me who was watching Oprah. I just want to confirm that. Yeah, they were watching Oprah, and I was walking by, and I saw the show. And this man, Robert Kiyosaki, was on TV, and I was like, oh, this sounds interesting. And he was talking about his then new book, Rich Dad, Poor Dad. That's how old I am, guys. No internet. It was Oprah. And I was like, oh, this is interesting. And I actually went to chapters, because I was I had just graduated, so I was still broke. At the time, I went to chapters to read this, because you could just read it and sit there and not buy it, right? So, no judgment, guys. So anyway, that's what I did. I went back and forth to chapters over about 2 or 3 days to read the book for free. But I was blown away. I'm not a big reader. I like listening to audiobooks, I like listening to podcasts, but sitting down and looking through pages has never been a big thing for me. So it's like, it was a big deal that I actually read this book. And there's this concept in this book which still sticks with me today, and it's what started my whole real estate journey. If you think about your wealth as this bucket, and the money going into it is your accumulated net worth, that's filling up with water. And for most people, there's one job, right? That's one tap, filling up that bucket one way. But you've got a ton of holes in it, right? You've got expenses, you've got your mortgage payment, you've got, I don't know, your baby mama. I don't know what those, no judgment again. I don't know what those holes are, but the concept of building wealth is to plug up as many holes as you can, turn on as many taps as possible. And I was like, oh, I just got this new job. I was working at this fancy place called Research in Motion. Don't know if you guys know. They're getting awesome. So working at this place, Research in Motion, and I was like, I only have one tap. I need more taps. And that's how I got into real estate investing. This is my first. You never forget your first. It was all wrong. It was my first, what do they call it now? No. What are those toxic relationship. This is my first toxic relationship, guys. So it was illegal. I didn't know, right? I didn't know any of these things. It was illegal. I had more people in there than was allowed. I don't know, I was living in a 10-person house at the time, right? It was therefore illegally subdivided. Waterloo has special licensing. I knew nothing about that special licensing. My parking, this is a picture afterwards. I found it on Street View. But they fixed the driveway, which was illegally wider than you were allowed. I didn't even know these things existed. But man, was it cheap. I've spent $115,000 on this semi-detached. So, I mean, those don't exist anymore. But it was cheap. Was it less risky? Like literally, I did all these things that were wrong. We'll talk a bit more about that concept later, but cheap was not less risky. And when I did this presentation before, I think it was Erwin Cito, if you guys know him. He's like, isn't your agent at fault from some of this? And I was like, yes, there is some fault there, but really, it was me, right? The risk I brought to this as an uneducated investor. I wish I had sat through something like this as we have today, so I would have gone from uneducated to educated. I could have maybe skipped some of those. Anyway, I kept expanding. I got to 21 doors in Waterloo, moved to Toronto because as a young man, Waterloo is not a cool place to hang out after you're a student. But it sucked, right? I was leaving my job at 5 on a Friday, driving up to Waterloo, staying in an actual bed and breakfast because Airbnb didn't exist at the time, working all day Saturday, fixing stuff, working all day Sunday, leaving there late at night, coming back and working my 9 to 5. And I want to quit. Like, that was not the dream. The dream was not to work 7 days a week, 80-hour weeks. That was not it. Like, what is this real estate investing crap that Robert Kiyosaki was selling? So I thought to myself, okay, somebody must be doing this right out there. I need to meet these people. And that's really the power of networking. So I went out to meetup.com, I searched for every real estate meetup I could find in a 1 hour drive, and I went to every single meetup. So I was doing 3 or 4 meetups a week. I was booking meetings with people, just like, hey, let's grab a coffee, trying to learn and trying to fill in that knowledge gap that I had. And I became a much more sophisticated investor. I actually met Matt, my business partner, through all of that. And we came across this same realization as we became more sophisticated. We realized not only were our Toronto investments doing better financially, but they were actually sustainable businesses because we had better tenant profiles. We had, less scale, right? I was able to achieve, without having to 10x my portfolio, which 10x is your problems, by the way, I was able to still achieve the things I wanted to achieve. Anyway, that's how I ended up in the city. This is what I did after I was inspired by real estate. That is my desk. My daughter asked me, why am I pushing over a cartoon desk? And we started Volition. So we've got a bunch of awards. We've been on HGTV. We spoke at the National Home Show. It's been going pretty good. Educated people, and we've invested a lot of money for folks, helping them do pretty much the same thing that we do ourselves. And here's some pictures of the family, so you don't think I'm some capitalist robot. I'm still a capitalist robot now I'm procreating. Anyway, this is the family. So that's me in a nutshell. And I made this slide because I wanted Andre to call me pretty.
You are pretty. You are pretty. Come on.
Hey, thanks, man. But in reality, one of the reasons we put the slide in is because we get asked all the time, what are you doing? What are you investing in? Tell me about you. And to be quite frank, I'm on the other side now where I'm starting to divest. I'm starting to sell off some of these properties. So unless you have a big portfolio, you shouldn't be doing what I'm doing. Anyway, that's kind of the point of this. Let's get into the intention for the day. As Andre alluded to, what we really want to teach you is not what is the best investment property to buy. We want to teach you the fundamentals, because the fundamentals will apply to any real estate market. You can take the knowledge you have there and say, like, okay, I'm looking at market X. Does it meet what I'm looking for? We want to teach you to fish, right? So what we're going to look at first is what drives a real estate market. What makes prices go up? Like, it's not random, right? We live in Toronto, so we've got this bubble mentality. We're the center of the universe. Prices always go up here, and that is true, right? But that's not universally applicable, right? You go out to, I don't know, Timmins. Prices I have no idea, but prices I can guarantee you, are much more stagnant than they have been here in Toronto, right? And there's reasons for that. So we need to understand what drives the real estate market. That's how you're gonna make money, right? So we'll start off with what drives the real estate market, understand the fundamentals there, and then we'll start working our way down that funnel. Okay, understand how the real estate market works. Therefore, now where in the world can I apply this? What makes sense? Given where in the world can I apply this? What cities, what neighborhoods, what streets, what property types? So we're gonna go from as big as you can get, the world, and we're gonna get down to the street level and the property level. Okay, so follow us on our journey. Okay, so this is the long-term real estate success formula. Have you guys seen this before? Nobody's seen this before. Oh, okay, come on. I expected a couple of hands. This has been around since the 80s, guys. This is not something that we have invented. I wish I invented this. This is from, what's his name? Don Campbell. Do you guys know who Don Campbell is? Don Campbell is the godfather of real estate investing in Canada. He wrote a bunch of books in the 80s and 90s about real estate investing. The numbers don't quite make sense now compared to what he wrote. You can't buy $50,000 homes anymore, for example. But the fundamentals of what drives that real estate market applies as much today as it did back then. So let's look at this. First, you're starting with GDP growth. Right? GDP growth, you guys know what GDP is? It's basically a measure of the economy, right? GDP growth leads to job growth. Companies are doing well, they hire people. Job growth then leads to population growth. Now that takes a little bit of time, right? companies put out their ads, try to hire people. You look at about a 12-month gap from the time that you look at a time from the postings gone out to the time that it's filled. Also during that time, you can imagine, let's say you've got a new job in Toronto. Never been here before. You're not just gonna go buy I hope at least, you're not just gonna go buy a house, right? You need to understand where you're living first. So because of that, rental demand goes up. People will come to the city, look for a place to rent, usually for about a year and a half-ish, right? Until they decide to buy. It's not necessarily because they don't have the money, but they want to understand the neighborhood first. Imagine you're going somewhere you yourself. So increased rental demand means decreased vacancies. Decreased vacancies means increased rents. Hopefully that makes sense for you guys. It's a simple supply and demand thing. When you have increased rents, property purchase demand, as now people are making their transition to become buyers, right? Or maybe it's the renters buying the place that they're renting. And that leads to property prices going up. So, if you've been to our meetups before, if you follow us on social media, we talk a lot about GDP growth, job growth, these announcements happening from the government, infrastructure development, blah, blah, blah. Why do we care about that? Because that's the root of what starts all these things, right? The reason property prices go up is because of those first few things at the bottom. Any questions about that? It's pretty straightforward. So, given that that is the cycle of events, I should put a bit of asterisk here. Obviously, if you have a 5% GDP growth, it doesn't necessarily mean you have 2% population growth. There's not a direct correlation, but these are the event sequence that needs to happen. If you don't have GDP growth, you're not going to have any of these things, right? So, where should I buy? Let's take the whole world as a possibility to move. So imagine you're a wealthy family and for whatever reason you want to leave the country that you're in currently. Maybe it's not politically favorable, maybe you're a Bitcoin billionaire and they want to tax you now, I don't know. But you want to leave. And what are your options? Like where could you possibly take your family? Some of the things you may consider are you want political stability, right? You're looking for a high standard of living. You want it to be safe, low levels of corruption, right? You're looking for a steady economy. Like these are generally things that you're looking for if you're leaving the country that you're coming from. Because usually one of these things is problematic where you are, and that's driving you out of the country, right? So let's run through some potential places that you could move. Okay, US. Maybe not the most immigrant friendly right now, right? Especially with some of the recent changes there. If you're a foreigner and you look like a foreigner, it may not be the best place to go to, right? And even before that, even under the previous administration, the US has always been harder to immigrate to, right? This is a much more lengthy, much more difficult process. Okay. So you might want to go there, but you may not be able to get it. Asia. So how about other places within Asia? We see ourselves as Canadians, we're like, oh man, our government's got crazy. We've got a prime minister who quit, we've got a finance minister who quit. Like that's nuts. But it's small in proportion to what's happening in the rest of the world. Like when our prime minister quits, there's a process. That process is followed. Somebody else will take their place. We vote. Like it's pretty civilized. Look at what's happening, I don't know, in Korea. I'm sure you guys saw the headlines. Basically a military coup there, right? That happened for 12 hours and then that went back. Like the Philippines, but the vice president has death threats out for the president and vice versa. Like they're on the news saying that if I disappear in the next 24 hours, it's because the president killed. Like that's nuts. Like that is actually crazy. So while we may not be, well, it seems like what's happening here is some political instability. We are far more stable than some other places in the world right now. Europe. I mean, this is a quote directly from the Center for European Reform. There's a lot of worry going to Europe now because of what's happening in Ukraine. It's very close to a center of war. And if you're trying to leave a place of instability, you probably don't want to go to another place which maybe could have some further instability. That's why people end up in Canada. And this isn't hyperbole. We have a lot of clients that come from out of Canada. And these are this is basically the collective stories and thought processes that we hear put into this slide. So politically stable, immigration friendly, we've got good healthcare, low pollution. That's another thing, right? Like we take for granted, you step outside, maybe it doesn't smell the best, but it's not polluted, right? You're not having to put on a mask because of the high levels of, particles in the air. But in many places in the world now, I think I was just reading about Bangkok. Bangkok is like the third most polluted city in the world now, right? Maybe a beautiful place, but there are literally days you're not supposed to go outside because if you have asthma or any sort of like breathing problems, you can get, it's bad for your health. High standard of living, good education, and we've got a relatively stable economy here. It's not very exciting, but do you necessarily want that for your family, right? High stakes, high risk, right? You look at a place like China, for example, which had a booming economy for a while. If you were in the right industry, maybe that was great, but if you were into pre-construction condos in China, you would have lost your investments, right? You'll lost your family home. Okay, so this is why people come to Canada. We kind of established that. So given it's Canada, where in Canada? So spoiler alert, if you recognize the DVP here, right here. So why Toronto? Why do people pick Toronto? Well, we've got some brand recognition. If you ask an immigrant, hey, you're moving to Sudbury, they have no idea what a Sudbury is, right? So part of it is brand recognition, but part of it is jobs, right? Big reason people move, big reason people stay is for employment. And a couple of years ago, maybe there was more allowance for work from home. That's been shifting, right? Like, there's a lot more back to work mandates, and because of that, there's a lot more wanting to stay within the core now, within the city. So, Toronto itself, back to this GDP, job growth, population growth stuff. Toronto, 50% of Ontario's GDP, 50% in our little Toronto area, and 20% of the whole country's GDP is generated by Torontonians. Good job, guys. Big labor force, and because of all this, our population's growing. We just hit 7 million. We're getting to, 10 million by 2051. 2051 is not that far away. I'll be alive still, I hope. And we're another 3 million people coming to the city. This talks about diversity, which is well and good. I like to think I add to that. But more importantly, you're talking about diversity of the economy here, right? A lot of people, when they're looking at real estate and real estate investing, aren't looking at the risks associated with the local economy. They're out in, pick an Oshawa, right? If you're in Oshawa right now, with what's happening with potential tariffs to the auto industry, you're pretty worried about your job. Well, if the local GDP is in trouble, what do you think that's going to happen to home prices, rental prices in the area? It's going to impact that as well. But if something happens to the auto industry, well, it's not great for Canada as a whole. Toronto is a lot more resilient. We're not single industry focused here, right? So we have diversity of industry. We have the most head offices of any city in the country here in the Toronto area. And here's a nice chart showing you the growth of the population. But where in Toronto? So now we've gone like world to Canada to Toronto, but Toronto is huge. Yes, Ling?
And before we move on to, just a question on going back to politically, government is restricting students, international students.
Yes.
A lot of them stay in Toronto for jobs.
Yep.
Everything is happening in education.
Yes.
It doesn't have to be now. Short-term outlook on rental, accommodation.
Absolutely. So it's a great question. So the question is like with the recent changes to policies, with recent changes to policies in general, we'll call it, how does that affect us as real estate investors? let me answer it in, let me answer. So, policies are important, but they don't change that arrow, right? If job growth continues, right? If the economy is doing well, the government needs to support that. It would be political suicide and also economic suicide to say like, oh, no, we need workers, they can't come to the country, right? We swung way the other way during COVID, right? Industry here was saying like, oh my God, we need temporary workers because, nobody is picking our crops. And they said, no problem, we'll make that unlimited. It wasn't the smartest thing, but that's what they did, right? They made it unlimited, a ton of people came in, and then we swung way too far one way. So now we're swinging back, right? And we will swing the other way again. This is what happens when it comes to policies.
Maybe highlight some economic fundamentals and market fundamentals.
Yeah, so, to Matt's point, an economic fundamental is GDP growth, job growth, population growth. And whenever you're looking at any market, you want to make sure you're seeing those things, right? Economic growth, GDP growth, job growth, population growth, right? Influencers are things that influence those numbers, but it doesn't change that sequence of events. So interest rates, right? Interest rates are high, people hold off. The population hasn't disappeared. The population's still there, and sometimes still growing. They're just waiting, right? Interest rates drop, all of a sudden buyers flood it, right? So there are things that are influence, and they are important to understand, and then you have your fundamentals. So policies, for the most part, are influential. So I agree, in the short term, probably it's going to even out what we're seeing in terms of growth, but we just let 1 million plus people into the country. There's still, a lot of them haven't bought yet, right? So we're still going to see the effects of that for a while. And I think it's the right thing. Like it was too much at once. Okay, so where in the city exactly? Andre's going to talk about that specifically, but it is basically where our tenants want to live. We take a approach where it's like, where do the best people want to live? I want to rent to them. Instead of, here's a property where the financials make sense. Now let's go find a tenant. Because good luck trying to find a good tenant, right? Find where the good tenants want to live first. Build your model backwards, not backwards from everybody else, right? Customers first, or your business, customers first. Property to support those customers. So these are the neighborhoods. The tenants that we like to have, and Andre will talk about this, like to live in these areas. They don't want to live out in Stouffville. They don't want to. I used to live in Stouffville, but they want to live out there. They want to live in the core. Okay, so now you're kind of educated on. What am I talking about here?
How do you make sense of the news?
Ah, okay. Yes, that's right. Okay, so. As you're going through this, right, you're thinking about, okay, I get you, Ming, you make sense. Now I want to be an educated investor. Okay? Many times, people make investment decisions without being properly educated. I don't think this room is like that because you guys are here. But my mom, for example, she calls me up one day. She's like, hey son, I've invested in semiconductors. I'm like, that's awesome, Mom. What's a semiconductor? And she's like, I was like, why are you buying things you don't understand? So, understanding the fundamentals, but now you still have to do research on this. Like, what's happening in Toronto? How do I understand the information that's being thrown at me about Toronto? Property prices are amazing. Property prices are crashing. We've got too many rentals. We've got not enough rentals. We're in a housing crisis. We have too many condos. How do all these things coexist? Are all the news outlets lying to us? Maybe. But let's put our own thinking cap. So what we do is we like to analyze things at a local level. Because for the most part, it's not that people are lying, they're just not getting deep enough. And real estate especially is hyper-local, right? And what we mean by hyper-local is it's like, We can't talk about Toronto in generalities. It's 7 million people, right? Can you imagine talking about anything else in generalities about 7 million people, right? People get hungry at 8 in the morning. No, there's probably a huge section of people who don't eat till 1 o'clock, right? So you can't do that on the real estate market either. We need to understand at a local level. So we take these are TREB neighborhoods, and we graph it out. And we see here, well, this is what actually is happening in Toronto. This is the home price index. Right? So we're looking at like-for-like properties, so a 3-bedroom, detached, single-family home, and we're tracking that. We're not looking at averages. Averages suck, right? If there's a lot of condos sold that month, it's going to pull your average down, regardless of what the value of your house is. So let's actually track the value of your house. So this is exactly what this is. And we can see since the peak in 2022, it's normalized. Right? A little bit ups and downs, but it's not like it's gone up like crazy. It's not like it's gone down like crazy either. Single-family home market in Toronto is relatively stable, right? But if you're seeing headlines that say pricing is down, it's because they're just averaging across the city. Right? They're putting this data in their condos. Sorry, condo investors. This is what you're seeing. Right? So you just need to make sure that the data you're looking at is deep enough to give you the accurate representation of the information you're interested in. We also look at other places, like the reason we focus on the downtown is for the majority of you, and the majority of you doing buy and holds, even BRRRR strategy stuff, this is what's going to apply. But if you're into more advanced, more interesting, more advanced stuff, you may also look outside the city. And this is the stats for outside the city. Now, something to keep in mind outside right now is that it's a bit hard to tell because of the scale, but there is a lot more variability in pricing. So it's more volatile. Right? The downtown core tends to be more stable when it comes to pricing, less fluctuations. It also tends to recover a little sooner. Not always, but usually you get a month or two of recovery in the downtown. If the downtown's recovering or dropping, it's going to happen in the outskirts. It's an early indicator. Okay, quick recap. So we've gone from big, whole world, little Toronto. But before we continue that journey now, because Andre's going to get into the streets, the property types, and he's going to get quite deep. I want to make sure that we're approaching this with the right mindset. So there's like 3 very important things to keep in mind as we're doing this. So first one, price, right? Price, value, and risk are separate concepts. They're not connected. We named this event today Blue Chip, what do we call it? Blue Chip Real Estate Investing, because that's our mindset, that's our approach to real estate investing. And we wanted to drive at that point that price is not equal risk. You look at just the stock market. If I were to tell you you're buying a 5-cent stock, is that risky? For the most part, yeah, a penny stock is risky, right? But the two are not necessarily combined. Because one is of a cheap price does not mean it is risky. They're 2 separate concepts. I'll give you another example. Let's say cap rates. Do folks in the room know what cap rates are, capitalization rates? Let me take 1 second to explain. So a cap rate, super simply, is a way of measuring the return on a property, on your investment. And basically you're just taking your expenses, the amount of revenue it's generating, and you say, okay, this property is a 5% cap rate or a 10% cap rate. So, sorry, who knew what a cap rate was? Okay. Let's say, Sean, because I know Sean knows for sure. Let's say I said to you, hey, I found this amazing property in a 20 cap market. What does that neighborhood look like to you in your head, a 20 cap market? So Sean is an institutional investor, right? He does big stuff and knows that because you have a higher return in that market, it is riskier. Cap rate, that return, is not only a measure of how much you're getting, but also the risk of that neighborhood. A 20 cap market, 20% return, amazing. But if you're sophisticated, you're like, why is it getting me a 20% return? You have to ask that question. You're not smarter than the market. Why am I getting a high return? It's because people are burning oil barrels outside to keep themselves warm, right? That's the kind of market we're talking about. When we talk about low cap market, a 3 cap, 4 cap, you're thinking, okay, like New York's, London's, Toronto's a little bit higher, kind of in 5 to 6 cap range, right? So cheap, value, risk, these are all separate concepts. And I just want to make sure that's very clear, because just because you're spending less money doesn't mean you're any less risky. Just because you're spending more money doesn't mean you're any less risky. You have to evaluate risk separately. Okay? No time for time. We have a jam-packed schedule today. We've got 9 speakers coming in. We usually have this about an hour or so presentation about risk, right? And this is really important, guys. Like, risk and risk framework is key to apply to all your investing. This is what we created. We wrote a white paper on this because we're cool like that. We wrote a white paper on this about the risk in investing. We will be going through this in detail online though, because I want to still make sure that everybody is learning about this stuff. At a high level, we're talking about these 4 areas of risk. Tenant risk, which is your biggest risk, by the way, because that's what allows your business to continue running. Investor risk, so that's the risk that you bring to the table. That's the risk I brought when I first started investing because I didn't know what I was doing. Market risk, this is not just what's happening in the market. This is your local market, right? Like, is the economy diverse there? Is there a single employer? If softwood lumber prices crash, what's going to happen to my market? And estate, the house itself. This is a 150-year-old building. What do I need to do to mitigate the risks of this old property? Is it in the right neighborhood on that street? Is it in the right area on the street, right? This is like getting even more local. We'll be doing the full presentation online. Please make sure you're following us. If you know us already, I imagine you are. But what we're going to do is we're going to post this online. We'll send it out to everybody as well who's on the list today, this full time presentation. Okay? Okay. Third important thing to understand, third important thing to make sure your mind is evaluating when looking at real estate investments. The role of cash flow. So the first one, when you're buying an investment property, everybody understands this first concept, and that's buying solely on appreciation. So I have this buddy, bought a condo. All he talks about is, I bought my condo at $500,000. My condo is now worth $600,000. And in his head, he's made $100,000. That's easy, right? We can all understand, hopefully that's like grade 1 math. Hopefully we can all understand the made money there of $100,000. But that's a very, very simplistic way of looking at real estate investing. And I don't see any simplistic minds in here, right? So what we want to do is take it up a notch. What's the next level of really understanding real estate investing? So the next one is cash flow, right? Cash flow is how much money you have back in your pocket every month. I, get $1,000 for rent. I have $800 for my mortgage, $100 for expenses. I have $100 left in my pocket. Amazing. And this is where most people understand this concept. Most people get stuck here though, right? They're like, oh, cash flow, amazing. I understand this. It's like a job. It's like turning on that tap. I've got more money coming in. And they end here. They end their real estate comprehension at this point. But what we want to get you here to today is to think beyond just that. Because real estate returns in far more ways than just cash flow. It's operating your own business, right? So we need to understand equity pay down. We need to understand appreciation. And when you're analyzing real estate and real estate returns, you have to be looking across all these things. And we'll show, I think in the pro formas at the end, how we're doing this. But know that cash flow is just a portion of that return, okay? when I was still investing in Waterloo, I found this amazing property, or I thought to myself it was amazing. And most of the market at the time was returning about $250 a month cash flow, right? But I, through my amazing genius, found a property returning $500 a month cash flow. I was doubling what most people were getting. So like, good job, Ming, pat myself on the back. I take this to my mentor. I'm like, look at me, I am awesome. I found this property and I'm gonna double my cash flow compared to everybody else. Tell me how good I am. And he goes, awesome, so you're gonna retire now? I was like, what? Yeah, you take that $250, retire. And I was like a bit baffled. And he's like, well, what's happening with the infrastructure there? The building stuff? Who are your tenant profiles? Tell me about them, right? What other government investing is happening there? What's the population change in that area? I had no answers, right? I didn't know any of these things. And I was just getting drilled with questions that I couldn't answer. And his point out of all this is that while cash flow is good and you need it, I was incorrectly prioritizing cash flow over other things. It was the sole means by which I was evaluating properties. So what is the purpose then of cash flow? The purpose of cash flow is to hold for the long term. Real estate doesn't make you money fast. If you guys are looking to get rich quick, you should just go, because that doesn't exist. Real estate is a get rich quick eventually, right? Equity has to build up, property prices need to go up, but you need to stay in it for the long term, right? If you're cash flow negative, you have a poor cash flow situation. Like any business, you can't ride out difficult times, right? And that's what you need to be able to do. You need to ride out pandemics when rent fluctuates. You need to ride out tariffs, right? So that's why cash flow is important. But it should not be the single thing that you're evaluating the performance of the property on. Those other questions, like what's happening in the neighborhood, your tenant profiles, infrastructure development, that's actually much more important because, I'll let you guys know in 2 slides why that matters. So cash flow is cap rate, essentially, right? What we talked about. And Toronto has less cash flow than many markets because it's less risky, right? The market has figured this out already. There's a reason you're getting lower cash flow returns in the city. It's because you have a diversified economy. It's because you have a strong local GDP. Right? These things have been, the market has priced this stuff in. It's not like as small-time investors are like, oh, how come, Cadillac Fairview is not investing in Timmins? They're not doing it out there because they understand this stuff, right? So watch your time video to understand that a bit more, because we do talk about that risk framework. But keep that in mind. This is why there's less cash flow in a place like Toronto, because there's less risk. Okay, quick question for the audience. 2 scenarios. You can have a property that has 4 times the amount of cash flow, so $2,000 a month of cash flow, and appreciates at 5%. And you have property B, 7%, only 2% more appreciation, and $500 a month cash flow. Which do you think has a better overall return? A? A's? Everybody scared? Don't worry. We'll just turn the cameras to you and feature you. Let's go through the math. Okay. So, $1 million home, which is like a shack here in the city. 20% down, 4% interest rate, because when I did this, interest rates were 4%, and Hugo can tell me if that is a pipe dream. Pipe dream-ish. We'll get into it. It's funny how the market moves. Anyway, 4% interest rate, 25 years. This is a very standard mortgage. Okay? And we say here $2,000 a month cash flow. So what we're seeing on the right here in this slide is we're seeing your red line here is your mortgage being paid down. And the blue line is the value of the property. So as time passes, your property's not only going up in value, your mortgage is disappearing, so your equity is growing. Does that make sense for everybody? But that green line is that cash flow taken and reinvested, I think like relatively conservatively, like 4 or 5%. Taking those cash flows and reinvesting it and adding it onto my overall return. Right? So at the end of 25 years, I've got $4.4 million total. Now I can tell you, as a long-time landlord, the reality of you taking all those cash flows and reinvesting it is not real. A lot of times you have property expenses, you've got repairs and maintenance. There are things that will eat that up, right? But let's just say you have a house that requires nothing in 25 years, right? That's what you end up with, 4.4 million. So this is why people invest in real estate, by the way. That's pretty good, right? Turn $1 million into 4.4 million. But $500 a month cash flow now and 7%, just 2% more appreciation. So the difference between Timmins and Toronto. Right? We end up with just under $6 million in equity, just because of that small amount of appreciation difference. This is why my mentor was drilling me with those questions, because he doesn't care about cash flow. He cares about gentrification. He wants to know that the population is growing in that area. He wants to know what's happening with the local economy. It's far, far more important. It's a $1.5 million difference between investing somewhere that has 2% below the Canadian average and the Canadian average of 7%. Right? Something.
This is where I'll challenge.
Math makes perfect sense, but if my investment objective is I want to be able to substitute my income in case I get laid off, then the
Absolutely.
cash
So,
flow matters.
the question is like, okay, that's good. I agree with the math, but does that meet my financial goals of not having to work or substituting my income? When does cash flow matter? When do you really need cash flow? Right?
You both have
Okay,
120
so
slides.
I will speed up. So when do you really need cash flow? At the end, right? Because $200 here, $200 there, you can't leave your job. You can't do anything. But a fully paid off property, as Andre was talking about, $7,000, $10,000, $12,000. Now that is actually life-changing. Real estate is an amazing tool to build wealth, to build equity. But it's like a mid-tool when it comes to getting your cash flow at the end. You can absolutely pay off mortgages and do things like that. But there's a whole litany of things you could get into. You could get into structured notes. You could get into, guaranteed investments of some sort. And that's more of the dream. That's what I'm doing. Taking that money that I made in real estate, putting in something else where I don't have to manage it. Right? So that hopefully answers your question. Build up that wealth, then stick it into something where you don't have to manage. So we're not suggesting buying negative cash flow. Absolutely do not do that. Right? It doesn't allow you to ride the ebbs and flows of the market, and it's not scalable. Can you imagine a business that the bigger it got, the more money it lost? That's tech. That's not real estate. Right? We're in the real estate business. So the bank's not going to lend you money if you're losing more money the bigger you get, and you need mortgages unless you've got that much cash. So you want to make sure that your cash flow positive still, so that way the larger you get, the better the performance of the portfolio. Okay, so this neighborhood here, you guys familiar with the city? This is Dufferin and Bloor. This west side of, I think they now call it Junction, Dover Court, Wallace, Emerson, worst name ever. This section here, I actually think we have clients in the room who invest in this neighborhood. Why we like it? Close proximity to public transit, right? You're walking distance, no more than about 15 minutes. This matters a lot for tenant profiles. A lot of them don't drive, a lot of them don't have cars. So they want to take public transit. It's going through major gentrification. Other people with lots of money have already done the research and are redeveloping the area, right? You have that huge development happening just at the north end of this, square here. And you've got Dufferin Mall also going through redevelopment. Okay? what works in this area in particular? You're looking at turnkey, triplexes, fourplexes, 4+1s to a little bit of a lesser extent. Because this area is great actually for 4+1s. The challenges are the laneways in this neighborhood. If you're familiar with laneways, we have a speaker this afternoon talking about laneways in particular, but you need a certain amount of access to that laneway. The access to the laneway is not the best in these areas. Young professionals, they like nice stuff, but they're not super picky. It's not like you're in like the annex or something where you need to definitely provide a much higher finish level, but you are still a condo competitor in this area, so you need to be as nice as a condo. Okay. In general, if you can be west side of Dufferin there, that will be really good, better pricing in that area. There's a fire station though right on Dufferin, so make sure you're not too close to that. Next thing, we'll call this neighborhood St. Clair West. Never heard anybody call it Northcliffe Village or whatever, all those other names up there. St. Clair West. Again, we like this neighborhood because of transit access. It has dedicated streetcar. Dedicated streetcar makes a difference. It's not commingled with traffic. So commingled with traffic is no better than a bus, right? Bus is not real transit. Yes.
So I'm familiar with that area, and like the schools in that area aren't the best.
Yes.
And the demographic right now is not the best. So again,
Yes.
are you just investing on the assumption that it'll get gentrified
So
eventually?
that's very observant. It's so as we were talking about earlier, the red areas in around Dufferin Mall, prime real estate investor, best tenant profiles, highest rents, but prices are higher too. So your cash flow is going to be a little bit less. Now to your point, Dufferin West, St. Clair West, not as nice, right? A little bit rougher, tenant profiles a little bit less good. Rents are still pretty strong there. Housing prices are quite a bit less. And gentrification is coming. So if you're familiar, there's all these condos that have been popping up along St. Clair, and it's like a cancer. It's spreading west along St. Clair. So that's exactly what we're saying. We want to follow where gentrification is going. So we know it's like nice down Humewood, really nice, right? Some really nice big houses, and it's moving west along here. So this is for a slightly different type of investor. Right? Somebody who wants maybe something a little more cash flow forward, is doing a 4+1 conversion, doing condo minimization. This is not as strong as, let's say, for Burr, where you're trying to really lift super high rents. But excellent observation. So you can see here, slightly different, slightly less higher paying folks. They're not like bums living on St. Clair West, but you're thinking more like somebody who's making a creative director's salary as opposed to a data analyst salary. So still doing well, still working in good jobs, but not as high. There's a cemetery there, which I think this is like the gold mine trick. If you look out, it doesn't look like a cemetery, it looks like a park, right? So rents are not significantly lower in and around the cemetery, but housing prices are. People don't want to buy there. Now, not to say it won't maybe impact your ability to buy and sell, or maybe it's a little tougher to rent. Takes a little bit longer, but you can snag a deal if you're close to it. Very specifically though, by the time you get to Rogers Road, it's not nice at all, and it's way too far from transit, so don't go by there. Just to touch quickly on your first point around sizing, you're essentially going up against condos, right? So what can you offer that a condo can't? Space is definitely one of them, because per square foot space is a lot easier to do in a 4+1 versus a condo. So that's something, right? It's all those like little things that you can do, outdoor areas which separate you, and you attract those people who are not going to look to rent a condo, but instead look to rent your property.